This podcast is brought to you by Knowledge at Wharton. Please visit knowledge.wharton.upenn.edu for more information.
Memorial Day, which marks the beginning of the summer driving season in the U.S., saw gas prices at nearly $4 a gallon all over the country, and even higher in states such as Florida. Globally, the picture looks more worrisome. Oil prices crossed a record $135 a barrel during the weekend of May 24th, though by Tuesday prices had come down to $131. What's behind these regular flare-ups in oil prices? What are the major economic and geopolitical factors at work? How does expensive oil affect the U.S. and world markets? And what can we expect over the coming months? Knowledge at Wharton discussed these questions and more with finance professor Jeremy Siegel, author of The Future for Investors, and with Witold Henisz, a professor of management.
As we know, oil prices jumped to a record $135 a barrel during this past weekend. Do you think they're near the top now? And if not, how much do you expect them to rise over the rest of the summer?
I think I would be presumptuous to even theorize about whether we're near the top. I don't think anyone really knows. It's my feeling that even OPEC has basically lost control of the price of oil, and they're going flat out. And I mean that they can push some more, but not easily. Given the demands, it obviously could go much higher, and I don't think anyone knows. I think it's a guess.
Witold, what do you think?
I think a guess and a lot of uncertainty is certainly accurate. There have been discussions recently of $200 a barrel oil. The big uncertainties are, is there more existing capacity in the OPEC nations? Can they produce it? And will any one country go offline? There's a lot of uncertainty in African countries, Latin American countries about whether they can maintain their production and expand it according to existing forecasts. We simply don't know the answer to that, and the traders are trading based on that uncertainty, generating the high price of oil today.
Yeah, I think a lot of people are not very sure about what are the major factors, economic and geopolitical, that are really driving the rise of oil. Could you help explain that a little bit for our viewers?
We're in a period of tight balance between existing supply and demand, which is generating a lot of uncertainty about the future path of both of those variables. I think the big uncertainties that we have to grapple with are how much more capacity does Saudi Arabia have, and how much can they bring online in the short term? We simply don't know. They haven't revised their existing estimates of reserves for some years, and we simply don't know whether those are conservative estimates or whether they can be expanded. And that's true in many countries throughout Africa and Latin America. We don't know what the future capacity and reserves levels are.
Yeah, and I think, as I mentioned, I don't think there's an easy way to increase supply, or at least significant supply in the short run. I think a lot of it is economic. It's hard to blame speculators because we don't see a lot of inventory increase in oil, which would be a sign that people are hoarding it at this point. And I think what is also the psychology is everyone wants a piece of oil because they want to protect themselves against oil price increases. So if I own some, at least I'll have something that'll go up when the price of oil goes up. Well, of course, if everyone tries to do that, it's almost like the sky is the limit because, I don't think everyone can protect themselves, completely immunize themselves against this oil increase. And that's what the upper threat is.
The other side is the demand uncertainty. How much more will demand in China and India and other countries grow? The other side of the equation, there's also a lot of unknowns.
Right. I saw that George Soros, the billionaire investor, was interviewed by one of the British papers over the weekend, and he said that primarily he thought that speculation was responsible and for the rise in the price of oil. But it sounds like you don't necessarily agree.
I think, there's a fine line between speculation and buying for an even more expensive future. I think, I think people realize how important it is to hold some oil-producing assets in their portfolio. And if everyone thinks like that, that will go up. It's not just speculators running a train, moving that up. This is a scarce resource that the world is using more and more rapidly. Peak oil is always in the air, and I think that's generating the increases.
I think if you look the probability that one country could go offline, driving a substantial increase in price, is something that people are trading on the probability of. Is that speculation or is that hedging? When Southwest Airlines hedges their future oil supply, they're lauded as being smart relative to the rest of the airline industry. That's not speculation, that's hedging.
Yeah, exactly.
Many of the media reports seem to make a connection between the weak dollar and the rise in the price of oil. Again, could you help explain what the connection might be?
It's more than just the dollar going down, because even if you measure it in euros, which has been one of the strongest currency, they've had a huge increase recently. And today we had the truckers in Britain calling for a strike because the price of gasoline is going up so high there, and they can't pass on the charges quite as easily as we can. And it's now a worldwide phenomenon. I mean, certainly as a year ago in dollar terms, we're up more than the rest of the world, but over the last 3, 4, 5 months, the increase has been so rapid that it's affected every currency.
I agree.
What effect is high oil having on inflation, the U.S. stock market, and the economy more broadly?
It's surprising that many economists felt that by now we would begin to see the higher oil prices move into what we call core inflation, which is those basic goods and services that are not directly oil and energy, because just in manufacturing, etc., we haven't really seen it. Because there's been downward pressure on home prices now. There's been some downward pressure actually on physician prices. Medical prices surprisingly have been very soft over the year, sort of offset the increases in oil. But with these recent increases that we've had, they've been so massive and so rapid, we haven't really had time to see how they might figure into the indices. And that's why I think over the next couple months it's going to be really important to look at these price indices. I don't think they're going to be as good.
I think there are two direct channels, one direct and one indirect channel that are really interesting to watch. One is just the cost of transportation, and that'll spill over into spill into certain goods, including foods and others, and also the indirect cost. As the price of oil keeps going up, we're starting to spend more on alternative fuels and divert efforts into renewable fuels. That's driving up the cost of agriculture. So they're both direct and indirect channels, which we can foresee in the next 12 to 24 months.
And we see the substitutes for oil, particularly in natural gas, has gone up dramatically just over the last 3 months. After remaining stable for many years, did not go up with oil. But just over the last 3 or 4 months, it's gone up around 40 or 50%.
Right. Another thing that many Asian countries have recently announced, for example, Taiwan, Indonesia, Malaysia, is that they're going to get rid of all the subsidies for fuel. What impact do you see that having on both the markets and the countries themselves?
I think there's a question as to whether that's credible. It was the removal of fuel subsidies that led to the downfall of Suharto in Indonesia. Whether it's really credible that they'll actually follow through on that promise in the face of popular unrest is a big uncertainty. So I take a step back and say whether that can actually happen before we really analyze its impact.
Although it's certainly more expensive now to maintain price lids, and it might be that some of these governments just don't have money, to be able to buy at the world price if they are importers, and then subsidize it down to the level that they had been in the past. So it could provoke a lot of unrest, even if the government had wanted to keep the prices lower.
Turning now to the U.S. economy, home prices fell in 20 U.S. metropolitan areas in March. The Case-Shiller index fell 14% compared with the level a year ago. Do you see any silver lining at all in the housing market, or will the downturn continue for the foreseeable future?
Well, the good news is if you didn't own a home and you were intending to buy one, you're getting a potentially good deal out there. If you had been renting, for instance, and waiting for the prices to go down. Also, for those people who wanted to upsize their home, were planning to do it and waited. People lost, of course, are those who bought in the last year, 2 years, 3 years at the peak, and that's what we're worried about because many of them are underwater with the threat of foreclosure, etc., and so on. That's been a very major depressing point. So it really depends on what position. There are silver lining for some people, but certainly not for all.
And more economic indicators are scheduled to be announced this week. ranging from new home sales to consumer confidence and also a few others.
We actually got the consumer confidence
Did it
today, and
come
it was
out
not
today?
good. It was,
not good.
I think it was another like a 15 or 16 year low. Yeah, this is the conference board. It comes out on the last Tuesday of every month.
Right.
We got that at 10 a.m. and it was another downtick. I mean, the double whammy of the home prices and the rising price of oil is weighing on the psychology. And it's all the surveys show near record consumer dissatisfaction with the way the governments are holding the economy and confidence in the economy itself.
So based on what you said, what's your prognosis for where the economy as a whole is going, and what can we expect to see?
Well, I did some just kind of back of the envelope type of calculations, and it was pretty sobering. We import about 12 million barrels of oil a day, and at $130 a barrel, no one knows it's going to stay there. It could go higher or lower. I mean, that's about 4% of GDP. Almost $600 billion. And that's doubled over the last year. So first oil was occupying 2%, now it's gone to 4%, so that's like 2% can be just if we could stay at these levels, chopped off the growth rate for a year of our GDP. And given that like productivity is up on average around 2 years of GDP, this whole process so far would cost a whole year's productivity gain into the U.S. economy. Now, with that said, it still seems like we're muddling along above zero, and our quarter is two months over, and most people are still saying this is going to be a positive quarter, just like last one's too. Nothing great, but nothing negative the way you would think of in a recession.
I think to end where we started a little bit, thinking about the uncertainties. The impact so far has been substantial, but we're still above zero. The uncertainties as to whether the credit crunch spills into auto loans, as was reported this morning, spills into other highly leveraged debt, whether the oil price has knock-on effects in food prices, such as I already mentioned, whether it causes, whether it leads to other spillover effects and instability in Africa, instability in Asia. These are the things we can't foresee that could really cause something devastating in the coming months.
So what are the key geopolitical risks that you are most concerned about going forward if this economic situation continues?
Well, under the current circumstances, any attack which would impact the supply of oil would have devastating consequences. An attack in the Spratly Islands, an attack in the Gulf region, an attack on a refinery. We just don't have the spare capacity in the short term. So we're really at risk of any break in the supply chain.
Are you talking about terrorist attacks?
Yes.
When you're referring to that?
This morning, I think there was a report that an attack in Nigeria was responsible for an uptick in the price of oil.
Yeah, some of the hopes about the price of oil falling, Buffett called it a bubble recently, were on the back of Nigeria's supply supposedly finally coming back online under Shell and others. But we can't be sure that that's actually going to happen. So yes, I think those uncertainties are really paramount on the geopolitical front.
Yeah, it seems like every time we say, oh, the price went up because of this, and that, then that thing disappears and the price still goes up. So there's got to be much more forces than some of the commonly used, phrases and explanations for that. And I think deep-seated increases in demand, deep-seated hedging, real hedging against that uncertainty, and a relatively fixed short-term supply, I think is just fueling this increase.
So to end with a variation of the question that we usually ask, we ask you most often to comment on what should be the strategy for investors going forward. This time I'd like to ask, what should investors and oil consumers be doing going forward? What do you think?
Well, let me comment a bit on investors because I follow that area pretty closely. I still claim if this is a market that would want to go up if it wasn't being hit over the head with oil at ever-increasing prices, because that is a big chunk as a major world importer of oil. If there can be some stability here, or if we can get back down to 100 and just stay there, I think we see the market up 15% from where it is, because you can just see the way it wants to get up, and then oil. But if oil continues at this rate or continues to rise, I think it's going to be hard slugging in the market. Not a panic, not a real sell or sell off, but it's going to be tougher for equity investors in the short run.
Witold, any final comments?
No, I defer to Jeremy on the broader macro questions.
Well, thank you both for joining us today. Really appreciate your time.
Thanks for having us.
Thank you.
For more information, please visit knowledge.wharton.upenn.edu.